We've all heard it on the news, right? The Fed raised interest rates today. It sounds so definitive, so powerful. But what if I told you that most of the time the Fed's big announcement is actually old news? Today, we're going to dig into a really fascinating paper that puts the Fed's true power under a microscope. And trust me, what it found is pretty surprising. So here's the billion-dollar question that economists have been wrestling with for decades. When the Fed makes its move, is anyone actually surprised? Or does the market, all those traders and analysts, already see it coming a mile away? It's a huge question because the answer really changes how we think about the Fed's actual influence. In this graph from the paper shows you the puzzle perfectly. See that jagged line? The one that looks like steps? That's the official interest rate set by the Fed. Now look at the smoother line. That's what the market was actually doing. See how the market's rate often starts dropping before the Fed announces a cut? It's like the market is one step ahead, sniffing out the Fed's next move before it even happens. This is the mystery we're here to solve.
To get to the bottom of this, we first have to wrap our heads around a key idea in economics, a shock. And, in plain English, a shock is just a surprise. It's something that happens that nobody saw coming. But when we're talking about the Fed, trying to measure a true, genuine surprise is way harder than it sounds.
What economists are really hunting for is something called a monetary policy shock. Now, this isn't the entire rate change you hear about. Nope. It's only the tiny piece of that change that genuinely caught everyone off guard. It's the pure, unexpected part of the announcement. And finding that little nugget is the key to understanding the Fed's real impact. For a long, long time, the tools economists used to find these shocks gave them a really blurry picture. The old ways of doing things had this one major flaw. They just couldn't separate the moves everyone expected from the true, out-of-the-blue surprises. Okay, so on the left, you've got the old way. It used monthly data. The thing is, a whole month is an eternity in finance, right? The Fed's decision gets all jumbled up with tons of other economic news, making it impossible to see what caused what. But the new way, on the right, now we're talking. It uses high-frequency data. We're looking at changes minute by minute. This lets researchers zoom right in on the exact moment of the announcement and pull out only the surprise. It's honestly like going from a fuzzy old photo to a crystal clear 4K image. And the paper gives this perfect, really powerful example with the rate cut after the September 11th attacks. If you look at the data for that whole month, a 0.5% cut seems like a massive shock. But in reality, not at all. Everyone knew it was coming. The markets totally expected the Fed to step in and stabilize things. It was a predictable response, not a surprise. The old methods just couldn't tell the difference.
So you're probably wondering, how did the authors get this crystal clear picture? Well, they came up with this really clever technique that acts like a super-powered magnifying glass, focusing only on the moments that actually matter. And it's pretty slick. The method is actually beautiful in its simplicity. First, you look at a really sensitive market interest rate, like a futures contract, in the minutes right before the Fed's announcement. That's your baseline. That's what the market expects. Second, you measure that exact same rate in the minutes right after the announcement. And the difference between the two, that tiny little jump or fall, that is the pure distilled surprise. That's the real shock. By using this high-frequency lens, all the other noise just gets filtered out. All the other economic reports, speeches, you name it. You are left with a clean, precise measurement of exactly how much the Fed's action surprised the market. It was a total game changer.
Okay, so we've got this powerful new tool. What happens when we actually use it? Well, when the researchers pointed this new high-frequency lens at the market, the results were, they were pretty startling.
Just think about it for a second. If the Fed actually delivers a true shock, a rate hike or cut that genuinely catches Wall Street completely flat-footed, what do you think happens to all the other interest rates out there, from short-term loans all the way to 30-year mortgages? So let's run with an example based on what the paper found. Imagine the Fed delivers a full 1%, or 100 basis points, as they call them in finance. Surprise rate hike. I mean, this would be a massive, completely unexpected move that almost never happens.
So what's the effect? The interest rate on a 10-year U.S. Treasury bond, which is a bedrock of the whole financial system that influences everything, jumps by over 0.5% instantly. That is a huge, huge effect. The old studies, using those blurry methods, found a much, much smaller impact. This proves that a true surprise really packs a punch.
And this graph right here, this is basically the smoking gun. That top line, that's the impact of a Fed surprise using the new method. Look how high and flat it is. That means a single surprise from the Fed doesn't just nudge short-term rates, it powerfully lifts interest rates all across the board, even for loans 10 years down the road. Now look at the bottom line from the old method. See how tiny that is? That's the proof. True surprises have a much bigger impact than we ever thought.
Okay, so why should you care about any of this? Well, this isn't just some dusty academic debate. These findings have major implications for our mortgages, for whether businesses decide to expand, and for how we understand the whole economy. So let's boil it all down. First takeaway, financial markets are incredibly good at anticipating what the Fed is going to do. Most of the time, the Fed's move is already baked in. Second, true surprises are rare, but when they do happen, boy, are they potent. And third, these shocks send powerful ripples all the way out to the long-term rates that affect mortgages and business loans, and that actually helps solve a long-standing economic puzzle.
The paper's authors put it perfectly with this quote: "The Fed never acts in a vacuum, right? It's always reacting to public data about things like inflation and jobs. They don't just change rates for the heck of it." And that leads us to one final, kind of mind-bending question.
I mean, think about it. If the market is reading the exact same data as the Fed, and the Fed is just reacting logically to that data, then are there any true surprises left? The authors leave us with this radical thought. Maybe a pure monetary policy shock doesn't really exist at all. And that idea, well, that challenges everything we think we know about the power of the Federal Reserve.